So let me ask before we get started, is there anything that you particularly want me to try and address or that wasn't clear from last time that you'd like me to go back over? Anybody that was here last time? Okay. Then we're going to go ahead and pick up. Is it about time to start, James?
Yeah, it's 6:32. You can start
All
now
right,
or
you
wait
want to
another
kick it
minute, whatever
off?
you want to do.
You want to get us started?
Oh yeah, I was just saying if you want to wait another minute, so no big deal. So yeah, absolutely. So welcome everybody to Teaching Tuesdays from Passive Cash Flow for Life. As you know, Nichole has a tremendous amount of multifamily experience, and then she also teaches a great class which I took 5 or 6 years ago, which is phenomenal and really gets you going and makes you successful as long as you do the work. And this is actually brought to you by that class. We kind of sponsor the Teaching Tuesdays, and the goal is to have 15, 20, 25, sometimes it goes as long as 30 kind of minute presentation. And honestly, to be totally transparent, most of ours have been closer to the 25 to 30 mark than the 15 to 20 mark. And then we have 30 minutes after that to kind of take questions, whether on the subject or on anything else to do with multifamily. And then tagged on right after that, we do single family with Jane and Sharon, who are on, and they're kind of the professionals or the experts on that. So I think with that, Nichole, it's all yours.
All right. So this is supposed to be, or this is part two of a two-part series on the information you need to know, the the numbers you need to know before you buy something. And it includes kind of the how the property is running. So that's kind of the existing numbers. You need to know how much it's going to cost you to get into the deal. That's the acquisition fees. You kind of need to know how much you can improve the flow of a property, how much you can improve its value before you buy. And you need to have some kind of idea about what are some exits. So any of you who are in residential, it's probably not a lot different, but there are some twists. So last time we talked about the numbers you need to know about the existing property and how it is working, what the income is, what the expenses are. You need to know how much it's going to cost you to get into the deal. Those are the acquisition costs. And we talked about that last time. So this, just to refresh you, this is a slide that talks about the total acquisition costs. And it is more than the down payment. It is all of these things. So if you're using a traditional lender, it is the points that they're going to charge you. It's the all of your fees, which include legal fees and includes recording fees. It's your underwriting cost if you're using a bank. It's the appraisal fees. It's the third-party reports like appraisals or phase one environmentals. The next line there are any costs or money you need to bring into a deal to get it started. So those are some reserves. It's money to open the accounts. If you have to repair things, it's the amount of money you need to bring in to get that started. And finally, it's the acquisition fee. If you're raising money from investors, we talked last time that typically somebody who's putting the deal together gets an acquisition fee. And that's kind of the money that you get in your pocket for putting the deal together. And it's typically 1 to 3% of the deal. So that you add all of those up, and that equals your total acquisition cost. And you have to know that because the next thing we need to know is what part of a deal can we own? So most of us are going to bring investors in when we go to buy a property, and um, that is going to be how much they get on their money, how much they make on their money is going to be basically what kind of return they want. And that's going to be based on how much they need to get, the dollars they need to get is going to be based on your total acquisition fee. So if you have to bring in $1 million to get this deal done, and that's a combination of down payment and acquisition fees and all of your reports, the closing costs, etc., and your investors want an 8% return, then that means they need $80,000 a year, right? So how much of the deal they need to own is going to be based on how much you have to give them for them to be able to get that $80,000 a year. And that is calculated in two pieces. One, it's the amount, the first part is the amount of cash flow that they're going to get on an ongoing basis from their distributions. And the last part is based on how much they're going to get when you sell or refinance the deal. So what we are really talking about here in this part of what deal can you own is based on their return, their desired return. It is rarely am I going to use the first year return, because the first year is typically doesn't have a great return because I have not been able to implement a lot of my value adds. And it's going to take a while to get the property stabilized. Even stable properties, you're going to need to bring some money in. So what you need to do to figure out what you can own is you take that desired return, which in this case is 8%, we just talked about. And your total acquisition costs are $1 million. That's $80,000 a year, right? So if the property is throwing off $120,000 a year in cash flow, so that's about $10,000 a month. Then what you're going to do is you're going to take that $80,000 they need for the year, and you're going to divide it by the total cash flow. In this case, in the example, it's $120,000. And so if you divide 80,000 by 120,000, then investors are going to need 66% of the deal, 2/3 of the deal. Okay. This is kind of a little bit of a simplistic kind of way. Again, we're probably not going to use first year. When we do projections, which is the next thing we're going to talk about here a little bit, you're going to figure out how much you are improving your cash flow every year. So for us to figure out what the total amount of money the investor gets back, right? It's looking at how long you're going to hold this deal. Because this is going to annualize. So they need $80,000 a year to get an 8% return on their investment. So if you hold that deal for 5 years, it's going to be 80,000 times 5, which is $400,000, right? And that $400,000, if you divide that 400,000 by 5, the 5 years you've held it, it's $80,000 a year. So we call it an annualized return of 8% or $80,000. Annualized return is made up of two pieces. We already talked about that. One piece is the cash flow, what the property throws off yearly in cash flow. And the other part is how much they make when you sell or refinance. To make it a little bit easier, I typically am going to try and look to see what that annualized return kind of looks like. The annual return kind of looks like from cash flow over the 1 to 5 years. All right. So if I am planning to hold this 3 years, then it's going to be 80,000 times 3, right? That's 240,000. So basically, this is a function of how long you're holding the deal and how much you can give them from cash flow. Most of the time, I try and use cash flow to figure out how much of the deal I need to give them, because on exits, it's going to be a bonus. So if you can get them, I'm making this up, if you can get them 8% a year from cash flow, then when you go to refinance, you can typically get them another 5 to 6%. So 8 plus 5 is a 13% return on their money annualized, because you're going to gain some money, at least we hope we are, when you refi, because it has gained in value. And we talked about that last time, how you calculate the NOI and the value. What I would tell you is we have to be cautious about giving away too much of the deal. So if you only looked at year 1, you wouldn't think you could own anything. But if you look at years 2 out, or 2 and 3, you begin to get a sense of what the numbers are really going to look like when the property's stabilized. If I have to do a lot of work with the property, so it's not a particularly stable property, it has a little hair on it, then I want to own more of that deal because I have to do more work. Most of your investors are going to be passive investors. If I have to do a lot of work on it, I want some equity in this. All right, we talked last time about a preferred return. That basically is a return that is guaranteed to the investors. And so if the first year I hold a property, it only makes a 6% return, or $60,000 in total cash flow, then the investor gets the entire 60,000, and I still owe them 20,000 in the next year or so to get them that 8% preferred return. If I can get away with not giving a preferred return, I'm going to do that, obviously. The issue is that a lot of high net worth people know this business and they have financial consultants who know the business, and so preferred return is pretty common. So it's whatever you can negotiate. Okay, so the last part I want to talk about here is how we figure out how much this property can make for us over time. And so when we are setting up before we buy, we have to project how much value we can add to this property. Now understand, in the projections are pretend numbers. So we do our best, but we don't know that we can get that. So we're generally pretty conservative when we do this. But a projection is basically, if we do this, this is what should change in the bottom line in the net operating income for this property. And so we have to figure out how we can add value and then how we monetize each one of those things that we add value to. And so I'm going to go through an example here. So let's say that we can raise rents $100 a unit because the rents are $100 below what most people are charging. Okay. So in 12 units, we have 12 unit property, right? That is $1,200 a month times 12 months. So I can raise my income by about $14,400 a year. Does anybody not follow what I'm saying here? Please, if you don't get it, let me know. Raise your hand, open your mic, and let me go back over that. This is really a fairly important thing for you to get. All right. So I am able to raise the income or the income of the property by about $14,400 a year. But half of that, or close to half of that, is going to go to expenses and other things. So I'm going to take 50% off of that. And with that $14,400 increase in income, my bottom line, my NOI, has increased by $7,200, right? So that doesn't seem so much. But if I am figuring that this property is going to sell or is valued at an 8% capitalization rate, if I take that $7,200 and I divide it by that 8%, I get $180,000. So by raising rents on those 12 units, $100 a month, I have increased the value of my property by $180,000. Right. We are not going to be able to do that in 1 year. If you raise rents $100 in 1 year on those 12 units, I will almost guarantee you that you are going to have some of those people move out because they can't afford it. So we are going to increase that maybe over 2 years, right? That we're going to raise those rents. And so we aren't going to see that $180,000 increase in value in year 1 or 2. It's going to probably be in year 3. We are not going to see that $7,200 increase in our NOI in year 1 because we're spreading it out. So one of the things we do is that we take, when we start looking at this property and we're doing our due diligence, we make a list of all of the things that we think we can do to raise the value of these properties. And we take those and we put them in a spreadsheet, and we're going to monetize each one of them. We're going to figure out how much that is going to increase our bottom line. And that becomes part of the basis of our business plan. We are going to show that to our investors that this is our plan. Conservatively, this is what we think we can do. And that then becomes, we show it to investors, we show it to our banks, and that then becomes what we need to do as we begin to implement what we're going to do. We use that business plan. Okay. You can't do them all at once. So for example, if the property's been paying trash for everybody, and we can raise rents $100 a month. What I can't do in 1 year is I can't raise it $100 a month and bill the trash back. Say that's $35 a month per unit. So I have to spread these out. You can't do it all at once. And we have to balance off what we're doing to raise our bottom, to increase our bottom line with what are we going to do to provide value to our residents, right? So that's another thing. We figure out how long we have to hold this property to begin to be able to get all of our value adds implemented. And that's a balancing act. If the longer you have to hold that property, right, before you refinance it or sell it, the more you need to give your investors. And so it is, because we're talking about annualized returns. So what I will tell you is that I never use less than 3 years, and I try to maximize out at 5 to 6 years, because that's where that seems to be kind of the sweet spot. At another time, we'll talk about why you really don't want to use less than 3 years on this. And a lot of it has to do with selling it and refinancing it and getting banks to be okay. Okay. So the last thing we need to know are exits. And that is, before we buy, we need to figure out how we can get that out of there. And so that is, we just talked about that, how long you're going to hold the property before you sell or refinance it. And that is really based on your projections. So once we have those numbers, we figure out what we can sell it for. What is it value at the end of 3 years, at the end of 5 years? And we look at how much the investor is going to own. So remember, whenever we sell something, we have to pay off the existing loans. We have to pay the investors their capital back. We have to pay the refinance prices or whatever those are. So that comes out of the value. And then whatever is left is equity. And that equity is divided equally between the percent of the deal that the investors own and what I own, right? So that becomes also another thing we need to look at, because if I really want to hold this, I don't want to sell it, I want to hold it and refinance it, then what I need to be able to do is have enough money that is mine in equity that I can refinance this. Okay. I want to have at least 2 viable exits. In residential, I'd like to have 3, but in multifamily, I want at least 2, right? And that is part of what can you do what's left. When you figure out what's left and how much is yours, part of that's going to determine whether you have to sell it or you can refinance it or you have to replace some investors. There's several things. So I have hit kind of the 30,000 foot review of this. A lot of this stuff takes some real calculating and working through, and we actually go into this in depth in the class. I don't expect anybody here to be able to kind of walk away feeling comfortable with this. It's a fairly complex set of thought processes as well as numbers for you to be able to get this down. What I want you to take away with this is that before you buy, you need to know what the numbers are of the existing property, and can you buy it at what number can you actually buy it? You need to know what it's going to cost you to get into the deal, e.g. the total acquisition costs. You need to know how you are going to increase the value of this property. That's number 3. And those are our pro formas and our projections. And 4, you need to know exits and how you're going to get out of this deal making some money before you go in. So it's not a lot different than residential. You need to know these things before you go in. All right. So that's kind of what I wanted to cover today. And as usual, I just want to hit a couple of things here and then we'll take questions. So if you want to get a better sense of what we do and what's involved in investing in multifamily, then I would encourage you to go to that bit.ly webinar, right? It's about 2 hours. It's free. It'll give you some good sense. If you have, I swear I changed that. Okay. If you just want to see what our website looks like, go to Passive Cash Flow for Life. If you have questions, don't go to info, go to support@passivecashflowforlife.com. I thought I changed it, but apparently I didn't. Shame on me. So it's support@passivecashflowforlife.com. And as usual, all of these Teaching Tuesdays are up on our YouTube channel, generally by Thursday. And you can go look at this, and all of our Teaching Tuesdays are up there on a playlist. So please feel free to go look at any of those and see what we've talked about in the past. Weekly calls, every Tuesday we have a call at 6:30, right? And mark your calendars. You can see this on YouTube. I think next week, I don't remember, but I think next week we're talking about the things that lenders are looking for in the investors and their buyers today. So what are the criteria investors, banks or lenders are using to decide? Is that what we're next week, James? So I actually can't remember. I was going to look and I forgot.
Sorry, I got too many things open. I'm going to double check for it because I know we changed a couple of things, but I'll come back in a couple of minutes and let everybody know.
Okay, so that's kind of what I wanted to talk about. And I'm going to, at this point, I'm going to kind of open it up for questions. And let's just kind of, so if you have questions about this, if you have questions about anything related to multifamily, please, please talk, please ask your questions. Do we have any things on the, so I have cash flow equals,
Sorry, I was answering somebody's question about what the 120,000 meant was for in the example you used.
oh, okay. And
Yeah.
you're saying that it's what now? You want to tell people? I didn't see the other questions.
No, this is Gene. Sorry, somebody had asked what the 120,000 in the example that you used, what that meant, what that was for. And I said that was the cash flow of the property. Go back one
Okay.
more, I think. Yeah. One more.
Where are you looking?
Yeah, it is.
There
Right
it
here.
is. Yeah.
Yeah.
Yeah, that was just an example of what the total cash flow would have been.
I did have a question, couple questions
Please.
actually, but is it typical that, the front end, which is the preferred rate that you give the investor, let's say like in this example was 60/40, let's say example, is that typically the same on the back end as well? Meaning when you sell, or can that vary?
No, most of the time it is the same. So they are investing to get a certain amount of equity.
Mhm.
Now we haven't talked about this, but there are basically two kinds, well, we talked about it a little bit. In syndication, there are two big buckets. One is a debt syndication and the other is equity. So if you go in with debt and they get a return on their money, so it's basically a loan, it is still a security for reasons we've talked about in the past. But in that case, you are just giving them a return, a number, a dollar amount based on their interest rate. But if they are in an equity position, they own that percent of the deal, both going in and coming out.
Roger that. My second question was, from a practical perspective, that 12 unit or any amount of unit, let's say you long term, you want to syndicators often have to, well, oh man, so many good nuggets that you mentioned that you, I'll just mention this one. So on the flip end, if you want to hold the property, is it advisable or traditional to just refi the investors, and as long as you give them their return, you're able to refi and keep the property?
Yeah, most of the time that's what I did. So what you sometimes have to do, that's why you really need to know your exits before you go in, because that's going to be how you're going to set up your operating agreement and your syndication. So if the investors own, I'm going to make this up. If investors own 60% of the deal and you own 40%, right?
Yep. Mhm.
And for you to be able to refinance it and get the investors out, just, pay them their return and their capital back, then they need, let's say they need $750,000.
Mhm.
And the property, when you go to refinance it, or because you want to keep it or sell it,
Mhm.
the property is only, the total cash flow and return is only $900,000. So you have $150,000 in equity in that example, right?
Mhm.
Okay. But for you to be able to refinance it with the bank at an 80% LTV, you need $250,000. So
Okay.
you're $100,000 short, right?
Mhm.
So when you're thinking this through, you have to figure out what are you going to do with that $100,000 to get that? And my options are, I can sell the property, which I don't want to do. I can keep investors in and just give them their capital back and they continue to own part of it. And all of the rest of the money goes to refi. I can replace a couple of investors with that $100,000 with a different kind of deal on a debt that I'm going to buy them out over time. And they're coming in to replace investors. So I have some things I can do, but I need to have a sense of where I'm going to land so I can figure out what that's going to look like and how I might be able to do that. Does that make sense?
Yeah. But your ultimate goal is to ideally own the property yourself.
Yeah, that's what I always wanted to do, but there's people who want to hold it for a certain time and sell it, and they want to take their money and put it into a 1031 exchange and buy something bigger that then they don't need partners with, right?
Mhm.
So that's a viable thing too. If you have that $150,000,
And
you
that's
have a fairly nice down payment on another 12 unit, and you don't have to have investors in it.
Gotcha. And that's spelled out in your PPM, because I've heard that it's not a good thing to, investors are not going to be too happy if you just buy them out and then keep it yourself.
It is, a lot of investors don't want their money tied up for a long time. And so that's not been my experience. Most investors are really trying to push that you're not holding their money for a long time because it is pretty illiquid. It's hard for them to get their money out
Roger
in
that.
this deal. And so they don't like to have that money tied up that long. So that's not been my experience.
Cool.
Some
Roger that.
people want out, some people want to stay in. So part of that is one of the reasons before we get investors, we need to know what they want and what their plans are. And they need to know what we're planning on doing. Why part of the PPM is your operating agreement that goes out with them so they can see what you're planning on doing. And I've had more than once where I have edited those operating agreements based on what investors want, and they're putting in enough money that I'm willing to do that. Does that make sense?
Yeah. I personally like your strategy because I'm a buy and hold guy myself, so it makes perfect sense.
I do so much work getting them, I just don't want to get rid of them.
Exactly. It makes no sense to me to even flip. So
All right, other questions from people?
Hey, Nichole, I have a question around the exit and what you've been saying with regard to some of the exits. So won't that also depend on various factors such as market conditions? Because even though you could have your exits, plan out, just like you said, when you're buying, you need to have them. But then there are other factors that will play out, such as market conditions, such as the performance.
Oh, yeah, you're right. You're right, Fred, that you're absolutely right. So, because that's what I said to begin with, that these numbers, the pro forma or the projections, they're pretend. We don't know. We think we can get there, but we don't know. Nobody knows what the market's going to look like in 5 years, right? So we try and be conservative, but things change. And that's part of our job, is to figure out part of what makes you be able to be more successful is to be able to figure out how you can pivot. But that means you have to keep an eye on what's going on. Because if things are changing in the way you don't like it, you may want out earlier. So I know that once the Fed started bumping up interest rates, I had probably a dozen properties that we went in and we refinanced early, that they weren't due for refi, but I could pretty much see the writing on the wall, what was going to happen to the interest rates, and I didn't want to be paying those atrocious interest rates. So we refied early. So some of that is you can't predict at all. Most of the time you're right, but not always. And that's part of the truth of this business. So what I always say, there's a really neat, at least I like it, saying that comes out of the stock markets, that bulls make money, bears make money, and hogs get slaughtered. So the key is to be fairly conservative and to have thought through what happens if the market's better, what happens if the market's worse, but don't get greedy, because that's where you start getting yourself in trouble. So you buy something that are outside your numbers, you think you're going to be able to sell it, you make decisions that are putting you, I mean, it's just, part of this is managing risk, understanding there's risk and managing it.
Right. Yeah.
Did that answer that, Ferd?
Yes, it did.
Other
Thank you.
questions? Have we got any questions there, James?
No, not yet. And again, it doesn't have to be specifically about this. It can be anything multifamily. And you can unmute yourself, or I know John was at work, so he couldn't unmute himself, but if you want to type something into the chat, that works as well.
you mentioned minimum 3-year to 5-year investment time frame. Why is that?
Oh, that's a big discussion, but in the short, I don't want to hold it. If I hold it for longer than 5 years, then because I'm paying investors on an annualized basis, they just get more and more dollars, right? So in the example, if we hold it 3 years, they
Okay.
get 240,000. If we hold it 5 years, they get 400,000.
Mhm.
If you hold it longer than that, they keep getting more. They keep getting $80,000 more each year that you have to be able to give them on exit for them to get that 8% return. Does that make sense for why we were paying attention to how long we hold it before we refi?
Okay, yeah.
In terms of the at least 3 years, it basically has to do with when you want to go into refi, what the banks or lenders are going to want to see. And the gist of it is, I mean, this is much more complicated than what I'm going to tell you, but the gist is that banks want to be able to see that the property is stable and has been stable for at least 18 months, and is throwing off enough income for what you want to refinance it at. So it's if you, so they want to be able to see that if you refinance it, and take money out to pay investors off, so you are basically putting more debt on the property, that they want to be able to see that your current performance on that property is enough to be able to pay that debt, and that it has been stable for at least a year to 18 months. That means you have to have a year to 18 months to stabilize and get it performing, and then you have to hold it there or improve it for another year to 18 months. So I would just say don't plan on holding it less than 3 years, unless it's going to be a major repositioning where you're just going to add tons and tons of value, and then you're going to sell it.
Makes
That
sense.
answer that?
Yes, yes. Thank you so much.
Yep. Other questions?
And we'll go ahead and put the link for the Teaching Tuesdays for people to register into the box here in a couple minutes. And as Nichole has always mentioned, we're trying to build a community, right? We're trying to get enough people that there's a lot of interaction, people can join up as partners, they can ask different questions, that kind of thing. So if you're getting any kind of value, hopefully you are, out of Teaching Tuesdays. When I put the link up there, if you want to forward it to a couple of people or something like that, that's fine. I've also got my email address up there as well, if you want to send that out. If they have any questions prior to, we're always more than happy to help anybody we can.
So I would also say that let me just ask, are there other topics, and James, if you could take notes, I don't have a pencil here real quick. Are there other topics you'd like to hear us talk about that would make you come to these more? So everybody just going to open your mics and let me know other topics you're interested in, pretty please. Everybody's so quiet. I can't figure out what to do to get people to talk more.
Hi, Nichole. It's Monty.
Hi, Monty.
How are you?
I'm good. Thank you
All
for
right.
talking.
No problem. Absolutely. I'm trying to get as much as I can out of this, and I'm glad that you're willing to take time out of your day, because you're so busy, to go ahead and help us newbies out. So the question is, when you're building your teams, where should you start? Should you start with a property management company? Should you start with reaching out to investors and potential people that could, provide capital for your properties? Where would be the best starting point?
I think the best start for your team is you need to figure out what markets you want to work in. But from the beginning, you need to be starting to meet with potential investors, and have kind of like a credibility kit of what you're planning on doing. And you start building those relationships now. Because that's kind of the reason most deals don't close is because people don't have the money lined up. Or they think they do, and people kind of bow out at the last minute. So we always overfund our deals. But I'd say finding investors and people like that. As far as acquisitions, I think the people you really need are brokers. As far as before you close, you really need to find good property managers. Brokers will bring you lenders. A lot of times brokers know property management companies. You're going to need good attorneys. You're going to need good accountants. So I think those are the 4 or 5 keys. James, what else would you add to that?
On there. Sorry, I was looking something up, so I don't know what I would add to that. So I apologize. I was trying to figure something else out real quick.
So what?
So I don't have anything to add because I was trying to figure something else out for the Teaching Tuesdays. So I didn't know I didn't hear the question.
Okay, so the question was basically, who are the most important members of your team to start building right away? And I basically said that I think the first thing is to try and find, to build relationships with potential investors. And then you need brokers, property management companies, you need accountants, and you need good attorneys.
I mean, I don't know what else I would add to that specifically, but people come to us all the time and it's like, what do I look for first? Do I look for a deal? Do I look for investors? And there are some people that say, if you find a good deal, the money will come. I've known a couple of people that have done that, and they said it was the most stressful thing they've ever done. Never, never, ever would they do it again. So as you begin your journey, or if you already started it, I would encourage everybody to kind of start touching base with people in your sphere of influence and just kind of mention, hey, something, I'm starting to look at multifamily and stuff like that. So the next time you talk to them and say, hey, you want to sit down for 15 minutes, it comes off as, oh, that's right. He told me something about multifamily before. It's not like, wait a minute, you're a software developer. What is this multifamily thing? So you kind of lay the foundation. And this is absolutely 100% a relationship business. Anybody that you talk to, I would encourage you to stay in touch with. And if you can help somebody else do something, it's kind of like planting that seed or kind of giving, and it may not come back directly from that person, but it may come back from somebody else. That is a principle that works across anything you do in life. You just give, and you just, with not the expectation of getting anything back, you just continue to give your time, your efforts, whatever it may be, and it will come back to you, 5-fold, 10-fold, 15-fold. In a lot of different ways, but relationships, I will be honest with you, the first deal is always the hardest, so it's kind of an unfair business, but you just have to get over that, get your first deal, and then things get considerably simpler and easier after that, but you do need to get your first deal, and the way to get that is really to learn your craft and to network, and just help people as best you can.
Okay, so there's a couple of examples there in the chat for ideas, and there's one question: can you explain how you overfund the deals? So my experience is that even if you send out member interest purchase agreement, which is basically the contract, and people sign it and say they're going to fund it, they go dark. They call and say something has come up. So what we always do is we try and fund at 3 times the amount we need. And we tell people we're doing that. And that we're doing that because our experience has been that at the last minute, there's a number of people who can't do it. And so it's going to be an issue of, we're trying to make sure we have enough money to close. And so first people who get their money in are part of the deal. And once it's funded, the deal is closed, and we would be happy to have you in the next deal. So I don't try and hide anything, but I always try and find, get overcommitted. So have 3 times the amount of money committed, or people saying they're going to do, because, people just disappear, and I don't know what else to tell you. So somebody said, this is what, oh, hi, Aristide. You said something about, this is what I need, investors, partners. Oh, his computer doesn't have a mic camera. Okay, that's okay. Send me an email. I think you still have my email address, about what you mean by investors and partners. And then there's a couple of other topics there. So
Hey,
you got, okay, go ahead.
This is Fednat again. So this question is around the acquisition cost. So hypothetically, let's say you have a deal that costs, let's say, 1 million, and you want to know the acquisition cost for that in percentage. Based on your experience, what percentage should someone have in mind, for the down payment and all the other costs that are involved?
So are you talking about you're buying $1 million property or you need to
Correct.
raise $1 million?
No, buying $1 million property.
Okay. So here's the, some of the, so you're going to need a down payment, which in commercial is 20 to 25%. Attorney fees are going to be about the same, whether you're doing a bigger deal or that deal. So I always calculate, 5 to 7% for my closing costs. And that includes, recording fees, and includes all of my reports, and includes attorneys, those kinds of things. But in smaller deals, it may be higher than that. So it's just, I would say you are probably got to get into that deal. You probably have the down payment plus $50,000 to $75,000 for all the other stuff. James, what would your thoughts be?
I would be along the same way. You do have expenses, and I guess you have a choice. You can either bring in your own money, or what some people have done is they'll find an investor that will actually front them a lot of the not just the deposit money, but other expense money, maybe in exchange for a larger part of the deal.
But what you have to understand, if you do that, if it doesn't close, unless you have a very clear deal with somebody, you have to pay them back.
Correct.
All right, who's talking about property management referrals? What was that? Is that Tanisha?
She was referring a
What-
property management company for the city and county here in Baltimore.
Okay,
Correct. I heard you mention some of the resources that you would need to have in order to be successful with your multifamily property. So I wanted to refer
good.
a company and that works in Baltimore City and Baltimore County that I know is it's really good.
All right, well, that's good. So everybody, if you are looking at Baltimore County, I hope you got that reference there.
Hi,
I
guys.
don't know if you have enough time for this question, but Tanisha also asked, what is the group's opinion and experience with investing in multifamily properties through tax liens?
I didn't hear the last word.
Investing through tax liens in multifamily.
So I've done a lot of tax liens in single family and duplexes and stuff like that. I don't see a lot of stuff in the multifamily. People just don't not pay the tax bills in those. But that is a really big price. So I really like tax liens and tax deeds sales, but I really don't see many of them unless you're talking about duplexes and triplexes and stuff like that in tax sales. So, but I also haven't specifically gone looking for them across the country either. Other questions, James?
Hey, Nichole, how are you?
Hey, Aristides, good to see you. I haven't
too,
talked
thank
to you for
you.
a long time.
I know I switched cameras. I was I mean, not cameras. I was in another Zoom, so I couldn't use this computer. But I like these small groups. We have more opportunities to talk to you.
All right, great.
Yeah, so I was referring to regarding partners and private money for that's one area that I have some people that I want to do business with us, but I think you kind of clarify when you said you overfund the deals. I think that's what one of the pieces that I needed. Like, you know, I was worried about like if I get a deal and I don't get it funded, because you know people don't have. It happens to us with rehabs, right? Like when people say, yeah, you know, they'll be ready to fund our deals, but whenever the deal comes, they don't have the money, or they said the deal is not what they think or whatever. So for a multifamily, I want to be ready. So when you said you overfunded by 3 times, I think that solves that issue. I'm gonna work towards that, see if we can do a deal,
Good.
you know, sometime soon. So
All right. I am at this point, Sharon and Jane, are you guys there? We're about ready to wrap this
Yeah.
up. So,
We're here. We're here.
okay, so our next so those of you who haven't seen Jane and Sharon, these are our residential gurus in terms of buying residential properties. And they have a special presentation coming up here in just a couple minutes. And so I'm going to log off here. I'm going to stop sharing. And I am going to turn this over to Jane and Sharon. And if anybody has questions that we didn't get to on the multifamily, please drop an email to support@passivecashflowforlife.com, and we'll get back to you in answering those questions. And particularly if you have any ideas about future topics, I'd appreciate it.
Next up.
Okay, and
So
just
I'm going to turn it over to Jane
it?
and Sharon at this point, and I'm going to mute my mic. And so let me ask before we get started, is there anything that you particularly want me to try and address, or that wasn't clear from last time that you'd like me to go back over? Anybody that was here last time? Okay. Then we're gonna go ahead and pick up. Is it about time to start, James?
yeah, it's 6:32. You can start
All
now
right,
or
you
wait
wanna
another
kick
minute,
it
whatever
off?
you want to do.
You want to get us started?
Oh yeah, I was just saying if you want to wait another minute, so no big deal. So yeah, absolutely. So welcome everybody to Teaching Tuesdays from Passive Cash Flow for Life. As you know, Nichole has a tremendous amount of multifamily experience, and then she also teaches a great class which I took 5 or 6 years ago, which was phenomenal, and really gets you going and makes you successful as long as you do the work. This is actually brought to you by that class. We kind of sponsor the Teaching Tuesdays, and the goal is to have 15, 20, 25, sometimes it goes as long as 30 kind of minute presentation. And honestly, to be totally transparent, most of ours have been closer to the 25 to 30 mark than the 15 to 20 mark. And then we have 30 minutes after that to kind of take questions, whether on the subject or on anything else to do with multifamily. And then tagged on right after that, we do single family with Jane and Sharon, who are on, and they're kind of the professionals or